in the world. All right, approximately half of the nation's workers do not have an employer-sponsored retirement plan, like a 401k plan. But could a government-backed option be a better alternative? They automatically put your money into a special type of account. Or would the government's entry into retirement benefits maybe do more harm to workers than good by making them think they're safe when they may not be? Let's find out. Nevin Adams is the editor-in-chief at Plan Sponsor, an online guide for pension and retirement issues. Let's talk. Okay, I know about these life cycle funds where they automatically change your investments as you get older. They try to get a little more safe. Now there are target date retirement funds. Talk to us about these.
Well, the asset allocation funds you're talking about, the target date funds, are an investment vehicle. They've been very popular in 401k plans. They've been, frankly, very popular in 529 college savings plans, specifically because you don't have to know anything other than when you're supposed to take the money out. So if you're trying to automatically enroll people in a 401k, for instance, you just say, how old are you, and you pick the right fund.
Problem is, last year, a bunch of them, well, blew up. There were some that lost a third or more of their value for people who were going to retire in a year or two. You say the government could come in here and start regulating how these things are structured if the fund companies don't really fix what is clearly a problem in terms of the amount of risk they're taking.
Exactly right. In fact, next week, the Department of Labor and the Securities Exchange Commission are having a joint hearing to talk specifically about these target date funds and really sort of look at them and what are they and how should they be put together. The big issue is their labeling. You've got 30 different funds out there called 2010. They have very different ideas about what that means. But to the consumer, it's all 2010. And so if you're retiring in 2010, you pick that fund. That's not always the best fund for you. Or, more importantly, sometimes it's the best fund, but it's not what you expect.
And I guess people can be misled. You know, a lot of people don't maybe track it as much as they should. But let's say you're going to retire or you expect to retire in 2030. And so you buy a 2030 fund. Looking in the research for this segment, it was, I guess there's people who maybe put too much optimism that that's going to be automatically set them for 2030, right?
People make bad assumptions. If you tell them here's a fund and you've got professionals that are going to manage the fund and you don't have to worry about it anymore, they won't
worry about it anymore. And then 2030 comes around, they're like, oh my God, I only have half the amount of money I thought I needed to retire.
Right.
What happened? By then it's too late.
Yeah, exactly right. Now, in fairness, some people who got in these funds, they might have been surprised, but some of them probably did better than they would have done on their own anyway. It's going to be case by case. One of them notably lost over 40%. That's a big surprise. I don't think anybody was counting on that. Many of them only lost 20%. But let's face it, the market hit all sectors hard. And if you're in the market, bonds or stocks, you took a hit last year.
It was stunning stuff. But in terms of retirement planning and investing for your retirement, the push by the government for automatic IRAs, again, when the government gets involved, there are always unintended consequences. Would that force a lot of companies to ditch their 401k plans, which would leave investors out in the cold and on their own?
That's the worry. The worry here, right now, only half of the people who work for a living in this country have access to some kind of retirement plan, 401k, a pension plan, whatever. So what the attempt is to fill that gap. Say, what about those other 50% of people who are working for a living, who are collecting a paycheck, but don't have any opportunity to save other than whatever they put in their own bank account? So the government proposal coming out of the Obama administration is to create an automatic IRA. And what it would require is that all employers who don't currently offer some other program would have to set it up so they would automatically enroll their employees in this program. The employer doesn't have to do anything other than set up payroll and pass it off. The details of how that money will be managed, who's going to keep up with it, and all that remains.
You know where this has worked really well? Chile.
Chile.
The nation of Chile. They did that. They basically pushed all their citizens into, it's private retirement accounts, but they sort of forced them to do it, and it's been a huge success. You know, as much as you may dislike government involvement, sometimes you've got to make sure that, people, and just put the money away, pay yourself first, and don't even think about it.
The problem right now is that the system in and of itself, the small business owners are more worried about staying in business than they are setting up retirement savings programs for their employees. What we know for sure is that employees who are given a chance to save for retirement do so. If you don't get the chance, they don't do it outside of work. So it's an alternative to kind of create a situation where they can do it.
All right, Nevin Adams of PlanSponsor.com. Interesting stuff. Thank you very much.
Appreciate it.
What if you're like Dagan, you've been 29 for 5 years? And which fund do you use?
If you're what?
If I've been 29 for 5
You have a
years.
retirement date, but you don't age.
Pick a different retirement date.
Nevin, thank you. Thank you for playing ball. So if you